best in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
You're listening to the Financial Survival Network. It's Kerry, Lutz, and the date is March 10th, 2016. I'm only saying the date because big things happening in the markets, plunging stock indexes across the globe, synchronized swimming, or we should say synchronized plunging, if you will, synchronized sinking, or anyway, we've got Bob Hoye with us. He's been watching it really closely. It's fascinating. Euro is down to 107.5. This is panic territory. Bob, I know you're not feeling great. You've had a horrible winter up there to the north, and hopefully it's over now, but we might be going into an economic winter here. Tell us your thoughts.
I think you got a good phrase there. I looked at things here earlier today, that I looked around and I thought, my God, this is a red tsunami sweeping global equity markets. And so you check, and yesterday's close in North America, they were up, and nothing disastrous there. Some of the commodities were steady. So it seems that the bid disappeared for equities as each of the Asian markets opened and then continued. There were some U.S. economic numbers were a bit weaker on the report earlier today, but no, this was just the bid disappeared. And you've got, on the other hand, finally, all the talk about the European Central Bank buying bonds they finally figured out a method to do it, and they more or less started a couple of days ago. So here we are. We're looking at the Russian and the Greek yields up a little, and you've got the yield on the benchmark German note down to 0.25%, or 2 bits, as we used to call that number.
Uh-huh.
So let them buy those things. But the whole purpose of, first of all, the Federal Reserve buying bonds was to make for better times. And then they, of course, rightly ended it. And at that time, that was a year ago, when the European Central Bank started talking that they would buy bonds. So that gave the street a year to get positioned on this. So it finally came in, and I think conditions for the Greek bond and the Russian bond are just so bad that those yields are going to continue to climb. Absolutely pointless anybody other than traders to buy the German note at 0.25 of 1%. I mean, it's an absurdity. So, but I think right at the start here today, the world is saying that the ploy by the central bankers to be buying bonds came to an end as far as boosting commodities. Because if you look at most commodities overnight, they started coming down as well, and that's the killer. We're into just plain old-fashioned deflation of financial assets, and it's taking commodities with it. It'll take other hard assets as well, I guess real estate, where it's still buoyant. England and in London, high-end prices are at the moon, and that's the same in Manhattan. But elsewhere, ordinary residential stuff in England started to get soft some months ago. So let's sum it up this way. The stock and commodity markets are telling us that the huge and vain attempt by central bankers to boost all asset classes by buying bonds has come to an end. Kerry, what we've got here now is that we've been looking at the excesses in the stock market. Since last summer, you had sentiment and momentum figures up at levels seen only at previous cyclical peaks in the stock market. I mean, the crowd was there. But you're in an environment where you had absolutely belligerent buying or talk about buying bonds. So that kept a lot of equity traders content or complacent. And so you look at that and you say, okay, well, now we had exuberance, then you had volatility in the fall, and also during the summer you had divergences where different indexes were going different ways. So you had warnings that a trader would regard, and yet, well, of course, you went to October, and the S&P came down in January to what we call a springboard buy. So the month when bad things can happen, September, October, was just a correction, and then we took off again here. So the one that we were looking at recently, let's see, from about 4 or 5 weeks ago, we looked at the old Dow theory, and that simply states is that for the bull market to continue, you have to have the Dow and the transports both making highs together. And if they don't make highs together, then it starts to give a warning. Well, the Dow and the S&P, the last highs together was at December 29th. So we looked at it 4 weeks ago, and that was then at 6 weeks count. And my colleague on the technical side really took a more detailed look on the old Dow theory, and noted that if you went for 6 weeks with a non-confirmation by the transport, that when the correction came in, it would be, sort of a 10% or a modest correction. But if the non-confirmation continued with the Dow going up and being not confirmed by the S&P, by the transports, then you get into something heavier duty. Well, we went until last week with 10 weeks. So this is, I think, of all the indicators we're looking at, the old Dow theory is working, and it's a play on words to look at what it's doing to modern portfolio theory, where you stay long no matter what.
Yeah.
And I think we're at one of these no matter what conditions. The bull market is 6 months old as of this week. The last panic ended on May the 9th of 2009, and you also had the economic expansion as weak and uncertain as it's been. It started in that June. The NBER determined that. So we've got a different world when you're in a financial asset mania. In the older world, when you had the stock market peak, as in 2000, the economy would keep going up for 10, 12 months later, and that was the case. Although you had that horrendous crash in bubble stocks, the economy did the classic high to 12 months later there. But when you're in a pure world of financial asset mania, such as developed on the way up to the peak in 2007, we noticed that in previous bubble peaks like 1929 and 1873, where you do have the National Bureau of Economic Research determination of the business cycle, that in 1929 the market peaked in September, the economy peaked in August and then turned down. So that was different. And then also going back to 1873, the stock market peaked in September and the recession started that October. And then you move forward to 2007, where we were thinking that if this was a classic bubble, when it turned down, it would take the economy with it, and it did. So you had the high for the stock market in 2007, and the recession started that December. So our thinking for the last few months has been is that when the stock market does roll over, it would probably take the economy with it quite quickly. And this has been the feature. I think one of the articles at Zero Hedge a couple of weeks ago pointed out that a lot of the standard economic series that the economists watch, which had been buoyant sort of into December, all of a sudden started showing weaker numbers and weaker than the economists who follow these things were projecting. So I think, and then of course you got today where the global stock market's washed out. This should be accompanied by a turn to weakening business numbers in the U.S. So this is why also this is showing up with weaker commodities. So then where would the average investor would like to be? Like to get 6 or 8% return at least, and you can't do that. So the regime of effectively zero interest rates has forced many investors into positions which are highly dangerous, buying bonds at ever lower yields. So our advice for investors who are in the fixed income side, for, let's see, a year ago in June is when we were looking for the speculation in low-grade bonds like junk to blow out, and it did, and you had a fairly good sell-off there, made worse by the collapse in crude oil right down till January. But the advice was to avoid lower-grade bonds.
Right, we talked about
and begin to go to the 3 to 4 year high-grade corporates. And for our Canadian accounts and accounts elsewhere, it was to have some of these in U.S. dollars because the U.S. dollar was going to go up. Mm-hmm. You were about to say something?
No, yeah, we had discussed that last time about avoiding junk bonds, that the average investor is just going to get killed in them, as they always do.
So you have to avoid, you end up missing some yield as you park in some safe place at a lower yield, but you end up being killed in price. So then on the fixed income side, we've got the other risk, which is not so much credit risk, but just price risk in long treasuries. And at the end of January, we got tremendous bullish technical measures on the long bond, the bond future, where it got up and upside exhaustion and all kinds of signals. So we were working on a theme called ending action, where the huge play in long-dated treasuries was getting technically overdone. Now, it's had a terrific correction. Then it sold off 9 points at the start, which is pretty good, and then bounced back about 4.5 points, and then now it's sort of dithering around. So there's extreme risk in the high-grade bond. So this is our choice to go to 3 to 4 years, where you won't get hit too much on an adjustment for credit risk, and you won't get hit too much on price risk. So that's that side. There's nowhere to go. And equities, well, as we were saying, we've been watching this old Dow theory for 6 weeks now, and it had given the sell signal a pending sell, so to speak. But we also used the image of remember the Roadrunner cartoons where Wile E. Coyote would run off the cliff and keep running, and then all of a sudden look down, and he went down. Well, this is where the stock markets have been. And Wile E. Coyote, I remember reading a biography of Chuck Jones, the cartoonist who headed that firm up, and he said that they found that when Wile E. Coyote lost it, they always let him fall for 18 frames because that was the funniest. Not 19 frames, not 20, but always 18 frames. So let's put it this way. I think I'm onto something here. We're now, Wile E. Coyote has discovered gravity, and we're at frame 1, and we've got 8.
Okay.
Okay, now what is this going to do to gold? Well, we're at stability today in gold and silver when most other commodities are under pressure. This is good because in the ultimate, gold is money, and in a boom where we have been for 6 years, gold doesn't do so well. You had the big sell-off, big boom in the gold sector, the 10-year bull market that completed in 2011. Now, we want to go back to there because there is something really important happened with that. And we learned a long time ago that when you had a bull market for both gold and silver, that while the bull market was on, silver would outperform gold. Mm-hmm. And then, I don't know, somewhere like about 1987, we looked back at 1980, and we noticed that the gold-silver ratio changed on that huge speculation. I think it was 3 weeks before the top was actually set in January 1980. So then that was one thing that Mother Nature was telling us, that when silver began to underperform, they could be both going up, but then silver, all it has to do is slow down, and gold keeps going. Then you've got the warning that it's over. So then later on, when you started getting these more sophisticated techniques on all these price series, we noticed that whenever you keep track of the silver-gold ratio and the momentum on that, which is for some reason called the relative strength, so the RSI. So we found that whenever the RSI on silver-gold ratio got up to about 80, it was saying you're in very dangerous speculation here going on. So let's go back to 2011, I think it was May, when the silver-gold ratio RSI got up to 92. So we looked back on the chart, and what happened was the last time it was up there was in January 1980. So we pointed out to our readers that this is highly dangerous speculation. There was no happy way out of it, and that the bear market wouldn't be as bad as the one that followed January 1980. But, you know, Kerry, when you really like the gold sector and you get in the bear market, they're always bad.
Yeah. What's a good bear market, right? Unless you're short.
Well, then here's how that indicator worked again. Because you went down, and then in September, and this was a very important point, but September 2012 is when just about that time, European Central Bank started talking about buying bonds, but of course they couldn't do it. But then Bernanke came in and said, that's it, we're going to start buying bonds. So I was at a gold conference then, and everybody got excited and said, oh, this is it, because this is going to really depreciate the dollar, and finally gold's going to go to 5,000. And and the work that we're doing then was saying, hey, look, guys, the silver-gold ratio, the RSI on it is up then to 84. So we said anything above 80 is dangerous, and it's highly speculative, and watch out. So at that point, and at the time, I wasn't so sure that the Fed buying bonds would be as effective as it turned out to be. I thought it would be a shorter effect. But anyways, it turned out to be a very heroic move. And you had the next leg of the bear market came down into last year, Christmas time. And then you had the bounce out to May. And you know what happened to that silver-gold ratio then? Mm-hmm. Right up to an RSI of 82 on that one. So we said, hey, anything above 80 is dangerous. Watch out. So what we've been doing in the gold precious metal sector is waiting for the oversold to come in. And so November the 5th did a special study on gold, because prior to that, say from the summer, we said that the gold shares could go down on seasonal basis, maybe into October, November, and we would stay away from them until then. So our November 5th piece pointed out that the downward pressures were getting severe, and what we would look for to bottom the sector would be gold shares beginning to outperform gold. So that started to appear about the middle of November. Mm-hmm. And the other one would be that silver would begin to outperform gold. And that then started to appear. So this was all part of the bottoming process. So our advice was to accumulate some of the gold shares on weakness. And that prevails, but we are still not fully invested. You now have the condition whereby the renewal of financial pressures will help gold relative to most things, but it may not help the gold stocks because you've got heavy weather on other equities. And you know the old saying, they'll throw out the baby with the bathwater.
Exactly.
So I'm not being gloomy on the precious metal sector, still cautious.
Yeah.
And
it makes sense.
So we would...
It does make sense.
Yeah. So, but here we're going to look at the difference between owning gold and owning the gold shares. Now, we're finding out now that owning gold in order to get even with the stupid Fed is not a way to make money. Mm-hmm. Actually, the quip is that you should own a little gold just in case you have to leave the country quickly and you want to bribe the border guards. I think that fits.
Some diamonds, too, isn't a bad thing, right?
But to own gold because the Fed is stupid, it has not been working, and it won't work. But the investor will look at the profitability of gold mining and note that when the real price of gold is going down like it does in a boom, and it did so like that, we do the real price of gold divided by our own commodity index, and that also had a peak in 2011, and it's been coming all the way down. And that representation of gold's real price had its low a year ago in June, and it recovered right up until January, and it's had a very big correction in here now, but I think it's going to get ready to go again. Now, the importance of this is that it represents the costs of mining gold.
Right.
So relative to the price you're getting for the bullion you're mining. And I think people can see it clearly that if you've got crude oil prices crashing relative to gold, which has happened, that's a reflection of, energy costs. And sure, you may have electrical power from a hydro dam, but your cost of blasting agents and everything else is all based on hydrocarbons.
Exactly.
And this is actually, so crashing crude oil price is very good for the gold business if it's falling faster than gold, which it has been doing. So we're now in a new bull market for gold relative to commodities. And it's had a terrific correction since January, but I think it's ready to do the next leg up. And it will eventually pull the gold shares into a new bull market because people start looking at their basic operating margins and the cost and everything else. So, and this is quite like any other post-bubble contraction or deflation in the past, is that gold has had its best innings during a post-bubble contraction. And so we're setting up for that again. And the advice again on the gold shares is own a few, buy some on weakness, but don't go absolutely fully invested yet.
Right. Yeah, well, definitely the energy prices. Also, so many of these mines have to generate their own electricity with on-site diesel generators. So that helps. Yep. And the heavy equipment that they use, the monster trucks.
Oh, even everything like cost of rubber tires for these big things. But, a few years ago when base metal mining was doing well, you couldn't get those tires. Now you can.
Exactly.
But this has always been the case that base metals go opposite to gold and silver, particularly gold. So you're going to have a lid on base metal mining, so that frees up miners. So there's a lid on wages. It's wonderful how Mother Nature works, and it's an in-depth focus here whereby that in a credit bubble, credit expands hugely.
Right.
Not only do the ordinary instruments of credit like bonds and stuff, but then they come up with lots of fanciful credit instruments that are really weird. Mm-hmm. So once that bubble's over, all this stuff contracts. This is why you keep calling it a credit contraction.
Exactly.
But underneath it all, Mother Nature knows that liquidity is needed, and that's provided by the gold sector, which has a unique liquidity. So the scared money right now will be positioning in gold for the liquidity, not for the price advance. Mm-hmm. So at any rate, this keeps the real price going up as everybody's liquidating copper, nickel, tin, etc. So, and despite all the hatred of the economists and central bankers for gold, that gold comes into the system and starts to reliquefy the whole credit system. And it's done it now in 300 years.
Right.
The bubble in 2007 was number 6, the South Sea bubble in 1720 being the first one. And each was followed by a long credit contraction where the gold sector did very well. So you can mark us down, Kerry, as being very bullish long-term for gold and very careful on entering in gold shares.
So one thing that I do find kind of interesting here is that people who are into gold, call them gold bugs, whatever, are no different than any other call them investors or whatever, aficionados of any other sector. They get excited and they get speculative and they go to extremes, just like anybody in any other sector, whether it's tech or internet or consumer goods, pick your sector. Gold investors are no different. And
that's right.
They just play off of political trends, economic trends, whatever their justification. We're no different than any other investors, and that's what I find so fascinating about human nature.
Well, there's also a mental difference that one should note is that on the regular equities, the fund managers, the retail participants, everything else, you're buying those equities because the Fed is providing you with a wonderful economy.
Right.
And as I mentioned a little while ago, people have been buying gold or the gold shares in order to get even with the stupid Fed. I mean, and I got to admit that the concept of central banking is the most audacious idea they've ever come up with. It's absolute madness. These guys assume that by fiddling with interest rates and fiddling with foreign exchange, that they can keep the economy going.
It's like daylight savings time when you get down to it, right? It's the same concept.
Talk to me about daylight
Isn't
savings
it the same thing when you get down to it, that somehow we can monkey with the clock and we can manipulate time and get the most out of it? But in the end, you only have 24 hours, right? Isn't it true?
Yeah. Oh no. Yeah. Here's the stupidity of it. Is number one, they assume a national economy.
Right.
Otherwise, you wouldn't have a national central bank.
But there isn't one.
And they think now. Here's the contrast. And our guys in Canada assume a national economy. Yeah. And we're sitting on the longest border between two countries in the world, and they assume a national economy independent of the U.S. and independent of the world. Of course, the Federal Reserve guys, they assume that the U.S. is a national economy independent of anything else. And as these credit markets have shown, financial markets have shown, now you've had a sell-off, a disappearance of bids for stocks and commodities just overnight in an instant. And this takes me back to the end of the horrendous bear market in November or December of 1974. Mm-hmm. And at the time, somebody wrote an article. I didn't save it. But you had a low for New York set in a couple of days.
Right.
And the same thing in Tokyo. It took a couple of days to set the low. And the same thing in Europe and in London. Mm-hmm. Then in each of those centers, New York, Toronto, then Tokyo, and then I'd say Paris and also London, each newspaper in its own jurisdiction wrote up a domestic reason for a worldwide change for the end of that nasty bear market. So on this one, if this is the start of a nasty bear market, it was all in a day or two. It'll need a few more days' work to conclude, but I bet you that every London and New York will all have a different domestic reason for a global change, and that puts away the idea of a central bank with a uniquely national economy. What, Kerry? It's so absurd. I can't believe it.
Yeah, well, it's like animal spirits. We each have a different reason for the animal spirits that are taking place, right?
Yeah. Yeah.
Yeah, well, if the stakes they were playing for weren't so ridiculously high, Bob, we could all have a good laugh and over a drink at the bar tonight.
Now, Mother Nature, yes, but it's the real world.
Yeah,
and Mother Nature just sits back and laughs.
Yeah, exactly, and that's the joke of it. And I think it was Sitting Bull or Geronimo when he heard about daylight saving. He said, the white man thinks that he can take a blanket and cut a piece from the bottom and put it on the top and thinks that he winds up with more of a blanket, but he's still got the same blanket. And that's central banking, right?
Oh, yeah.
It really is.
Well, I think two things are going to happen in the next few years. They're going to get rid of changing the clocks.
Yeah.
If daylight saving time is that wonderful, put it there and leave her there.
Yeah.
If it requires extraordinary diplomacy, change it by half hour and leave it there. Yeah. So the public's going to act on this. And then the other thing is, we go into another recession, a contraction. The public's going to look at all of the promises that the central bankers made and all of the tax money's wasted on, because at the end of the day, the public is accountable for what these fools have been doing.
Yeah.
And they've been spending, effectively, taxpayers' money in a manner that has never been done in history.
Right.
So that there is common sense in the public. It just takes something to prompt it. And I bet you both the daylight savings time and the severe criticism of central banking will happen at the same time.
Hey, great.
There's my big projection.
I love it. I hope you're correct on both scores, Bob. Hey, just tell us tell us where we find you again. Your website.
Yeah, I'd be glad to.
Sure.
Institutionaladvisors.com, or the internet being what it is these days. If you just Google my name, Bob Hoye, then up comes articles and the website and everything else. And we're delighted to have new prospects and people look at them. And we put you on for 5 or 6 weeks. You like the product, you take it. If you don't, you walk. It's real easy to do.
Yeah, well, I love the history. I mean, I'm really a history buff first and foremost. And you read history, and it's all about the folly of man, all about trying to get the extra hour of daylight, whether it's in your personal affairs, your financial affairs, or farming, whatever it is, and it just can't be done. So let's just give it up, accept it, and go on. But they just can't leave well enough alone, and that's really the problem. Anyway, Bob, it's always a pleasure. You feel better. Spring is on its way in spite of daylight savings time. It's still going to get here just at the same time, and Groundhog Day and all that. So we'll talk to you in a couple more weeks. Feel better. Thanks so much.
Okay, good to be with you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.